Last week you said you can have a look at silver. Yes, okay, let's do this quickly. Let me show you also my approach, right? You're on TradingView, you enter some letters. So in this case, silver, you will get to the symbol search. You enter silver, then / and then something like USM2. Okay, so now you get the silver price relative to the monetary base. Because TradingView has a bit of a problem plotting very small numbers on logarithmic charts, I normally add a multiplier on there, so times 1 with many zeros. And now we get the silver price relative to the monetary base. And that's how I look at many assets, right? Especially on commodities that don't have any regular cash flows. We can see how well do they stack up relative to monetary debasement. So if there was no devaluation of the dollar, how would actually the asset do? And it gives us the nice squeeze of silver in 1980s. It gives us an idea of how high silver can go. It also gives us an idea how high silver went compared to the rally in 2011. We can also then look at the average price, right? How much was silver valued relative to the monetary base in general, and how did it fluctuate around it? Are we currently above or below? And what this average price implies now is that this particular asset that we look at will always perform relative to that asset in the same manner. As in, we now expect, because the dollar depreciates by 6.8% per annum, that silver appreciates by 6.8% per annum, right? This is pretty much what this dotted line here means. That then would mean that silver would keep its value long term. Does it though? That's the big question, right? Because silver also gets mined over time. The silver supply expands as well. The US dollar supply expands over time by 6.8%, but the silver supply expands as well. And probably, because it goes up over the very long term, it doesn't expand by 6.8% per annum, but it still expands by 1 or 2%. And so probably this average price that we see here is even an overestimation of equilibrium price. Probably long term, this should rather go down slightly. And we do see how those bottoms here, right, how they align to a degree. So maybe that's actually how quickly silver gets mined. And that's maybe the kind of analysis we should really draw, how much more upside or downside there is. Have a look at this, right? Those two tops also somewhat align. And of course, we had this short-term manipulation. We had the silver squeeze. But in general, right, I would not be too optimistic. We just look at silver now and we look at its peaks in the past. It's not necessarily that enticing to get into silver. There's always a way to potentially still ride the current momentum, but then treat it as a momentum trade, right? If then the momentum turns around, sell it quickly. If you're now buying silver in order to hold it over the next 10 years, I don't think it's that wise to do, right? It's historically rather expensive. Hello Gerhard, thoughts on the Trump tariff being kicked back from the Supreme Court? I try not to trade based on political developments, because here's the thing, right? If we want to beat a market, we always need to have some kind of edge, right? We need to have a long-term reason why we should beat the market. There's always two components. There's the luck component. There's some randomness in markets because we don't know what a big whale will do tomorrow. But there's also skill, right? There's long-term trends that we try to anticipate. There's also potential knowledge that we might have, some information edge that we have over other market participants, because we're just more informed, because we have a better network, because we've got better analytics, because we've got a better data stream. So there is some kind of portion of our performance that's random. There's another portion of performance that's not random, that's skill. And so you need to have, if you want to long-term outperform, not just based on luck, you need to have some kind of skill edge. And so I'm always wondering, what is actually my skill edge in a market? Where do I have a real reason why the market long-term should reward me and not the competition? And of course, competition has different strength, right? If you look at the competition, say, in the currency market, where there is big hedge funds, big quants, big math PhDs that are trading this market, then competition is very high. It's very hard to beat this. Whereas when we look at the cryptocurrency market, where there's a lot of retail investors that trade random meme coins that don't have any value, the competition is weaker and the market is smaller. The market is very fragmented with all of those different altcoins. So it's potentially easier to beat. That's the idea. If we now look at, say, tariffs, right? When we look at political developments, I have to ask myself, do I think that I have any kind of edge anticipating what the political development will be? Am I that deep into politics? Do I know the politicians? Do I know the lobbyists? Do I know anything that the vast majority of people don't know in order to beat the market? If the answer is no, if I do not have any specific knowledge, any knowledge that most people don't have in a particular market or in a particular way of trading the market, then I don't try to trade it in this way, right? I don't try to trade based on politics if I don't know anybody in politics, and if I don't have any insight that most people don't have, if I don't know any lobbyists. And so I simply ignore those facts. I do acknowledge that political developments do have impact on prices, but if I can't anticipate them better than the average market participant, I just ignore this. So I try to find my edge in different way. I try to then hedge against this, right? So if I say maybe I think that asset A will underperform the general market, let's say I think Tesla is overvalued. I don't believe that they can pull off the humanoid robot story, right? If that's my belief, and by the way, it is my belief, but let's say that's what I want to trade on, and I want to bet on falling prices of Tesla in that case, and I want to not have any exposure or little exposure, as little as possible, to say political developments. I just hedge that bet. So I bet on falling prices of Tesla, and at the same time I bet on rising prices of, say, the Nasdaq 100. Even though I might not be bullish on technology stocks as a whole, I just want to get rid of the macro risk. Right? I don't know what the macro risk, say the political risk, will do. I just want to bet on Tesla doing bad, and so I just play the delta. And so I do this in crypto, right? I go, say, long Bitcoin and I go short many altcoins. I might also do the same in traditional finance. If I've got a strong opinion in traditional finance that something goes down, I might not just bet on the price going down, I might bet on the price going down plus the benchmark going up, and then we tend to make money. Why do I always talk about betting on falling prices? Why do I so rarely bet on rising prices? Because that's what most people do, right? Most people say, I am very bullish on this particular company, I buy the stock of that company. Or I'm very bullish on this particular crypto project, or I'm very bullish on this particular commodity, and so I'm buying it. The reason why in general I tend to rather do the opposite, I tend to rather pick a few losers than pick a few winners, is because picking the losers as per tendency is much easier. And this is counterintuitive. This is what most people don't really think about. But when you think about the market structure, any market for that matter, it's a winner take most market. The winner takes most. The majority tend to be losers. The majority tends to underperform the benchmark. So if you look, say, at the Nasdaq 100, right? We list the Nasdaq 100 stocks. 100 stocks, right? We list them. And we look at their performance in the last year, right? We order them by their performance in the last year. And then we look at what did the Nasdaq 100 do as a benchmark overall in the last year. The benchmark overall, if that's our threshold, and we look at the stocks that outperformed that threshold and the stocks that underperformed that threshold, we will have pretty consistently 75% of stocks underperforming the benchmark. So 1/4 of stocks outperforms the benchmark, 3/4 of stocks underperform the benchmark. If you buy just the Nasdaq 100 ETF, you get the typical return, but the typical return is just the average return, right? It's the average, it's not the median. If you pick an average stock out of the Nasdaq 100, you just randomly pick it, you have a more than 50% chance of underperforming. The chance of underperforming by picking a random stock is 75%. Again, because returns are very much concentrated, right? A few stocks outperform massively and the vast majority of stocks underperforms a little bit. And that's why it's so dangerous trying to pick individual assets to buy. If we make idiosyncratic bets on something, it's much safer, it's much better to have the odds in our favor to bet on falling prices. Now, what this also means, if you already know that the vast majority of assets underperform the benchmark anyway, what that also means is that we don't necessarily have to take the assets that have a lot of discussion around them, that have a lot of trading around them. So Tesla was one example, but maybe it's better to just take a very boring stock that most people don't have on their radar, that just tended to underperform the benchmark long term. And we just take that and we just short that, relatively speaking. Right? The same way as we short altcoins, We don't necessarily short the altcoins that everybody is talking about. We short the altcoins that nobody has on their radar. That's just long-term bleeding, where, say, the team has already completely given up, where there's maybe no development at all anymore, but the market cap is still 1 or 2 billion, and there's tokens getting issued all the time. That's constant selling pressure. We short that. We don't necessarily short the token that everybody talks about at the moment in time, because that, of course, creates a lot of volatility, and volatility, right, a lot of movement, the price up and down. That's potentially an enemy for us, right? What we want is very constant underperformance. So let me show you what I mean. Let's take the regular stock market. So let's take Johnson & Johnson, right? J&J, a very regular consumer good stock. And I don't know how well this performs now. But let's have a look at this relative to the S&P 500 over the long term. And let's get over the very long term here. So we see Johnson & Johnson in the early days was an outperformer because it's one of the few stocks that survived, right? When you look at stocks that already traded, say in 1968, that are still relevant today, of course, pretty much any stock that you will find will outperform. But have a look at, say, over the last, what is this? 18 years, it just underperformed the benchmark by 51%. So does it really make sense in this case to buy Johnson & Johnson when over the course of the last 35 years, it just performed exactly the same as the S&P 500? I don't think so, right? Because Johnson & Johnson as an individual stock is more volatile compared to the S&P 500. We take on more risk. So we might as well just buy the S&P 500 as a whole. We might just buy VOO, right? The S&P 500 ETF. So why buy an individual stock with all of this additional risk if you can get the same kind of performance by buying the entire basket? And so if you wanted to short, we could of course short something like Johnson & Johnson. But that's just one example out of many. And so in general, I think about it this way, right? I don't try to find the one winner. I try to rather have the odds in my favor. And in order to have the odds in my favor, I just bet on falling prices if I do specific bets. Usually, this tends to be the best, of course, unless you've got some kind of very strong market edge that goes against the 75% rule. So if you can beat the market that well, that you can pick the top 25% performers versus the 75% that lose, if your edge is that deep, then of course feel free to do it. But if it's not, then be careful picking individual assets to buy, because most of the time it goes wrong, especially if you buy many, many different kinds of assets, if you've got a diversified portfolio. Hi Gerhard, so many comments on the tax situation. First of all, maybe a comment on the tax situation. The numbers imply rising inflation and potential QE following. This could fire on BTC before they fall again. Do you agree? So yeah, regarding taxes, I don't look at it too much. Everybody that's like really big in the market in general tends to not be affected by taxes because trading happens outside of jurisdictions where taxes have big implications. So many companies just set up offshore companies that do the execution of trades. Regarding inflations and QA, what I tend to do is I try to do trades that are specific to my thesis. So this is maybe something that most people also don't do. Most people look at secondary and tertiary effects and trade based on that. So they think, okay, maybe the monetary base will expand faster, maybe interest rates will come down. Thus, when interest rates come down, there will be credit expansion. Thus, when there is credit expansion, my particular risk on asset might benefit from this more. Thus, I buy Bitcoin now. But I think actually that's a mistake. I think it's much better to rather do the pure play. So let's say you are of the opinion that interest rates will come down. Maybe you think that economics are actually very poor. We've got our K-shaped economy. We've got concentration of capital in the hands of a few. The vast majority is struggling. And because of that, we will have less and less consumer demand. Because of that, employment will be a problem. Because of that, interest rates will get lowered. Just an example as a potential scenario. If you want to play the interest rate game, if you want to play the interest rates come down, why not just buy long-term government bonds? Why bet on the credit expansion and buy the Nasdaq 100 when instead you can just buy long-term government bonds? Long-term government bonds are the purest play on interest rates coming down. There is, of course, the risk premium, right? How stable will the US dollar be? But in general, right, if you expect that the Federal Reserve will lower interest rates, you want to buy long-term government bonds. And you can do this in a levered way with ETFs. So there is the idea, right? So how do bonds in general get priced? The nice thing about bonds is that we know the future cash flows, right? We know how much will they pay over time. We know the coupon payments. Once a bond issued, the coupon payments are fixed, at least for the regular bonds, right? Not for the inflation protected bonds, but for the regular bonds, the payments are fixed. We do know the coupon payment. Now, when interest rates come down, that means that the future cash flows of that bond will have to get discounted less. Right? The risk-free rate is coming down, we discount the future cash flows less. Because we discount the bond cash flows that are fixed, because we discount them less, they are valued more. They are worth more to us. We have got a bond that pays, say, 7% every year, fixed, and now the risk-free rate comes down to 0. Suddenly that thing that pays us 7% every year is worth a lot to us. And so we've got an inverse relationship between prices of bonds and interest rates. When interest rates come down, then the bond prices go up. When interest rates come up, bond prices come down, at least compared to what the market anticipates. And so if you think that interest rates will suddenly crash and the market doesn't have this yet on the radar, and then the market indeed adopts to this and interest rates do come down, then your bonds will go up. And you just buy levered ETFs on long duration bonds. You can buy TLT, you can buy TMF. There's several ways to play this game, but that's, I think, the better way to go about this. If you are very bearish on interest rates, if you think interest rates come down, do the direct play, right? Don't necessarily play this over 10 corners. Don't necessarily think credit will expand because interest rates come down and so I buy Bitcoin because of this. On wait, maybe I don't buy even Bitcoin. Maybe I buy Ethereum because Ethereum is more volatile, or maybe even Solana. It has even more volatility. So let me buy Solana now because I expect interest rates to come down. I think this is a bad idea. Don't think this is the best way to go about things. I think it's much better to do the pure play. And in that case, for interest rates, it's just bonds. Bonds are the best play for interest rates. Hi G, what are your thoughts about AI? And do you believe it will rewrite the structure of global economics in a big way? Mass unemployment, universal basic income, etc. It's very hard to say how politics will change based on economic development. But yeah, I do think that AI mainly is a catalyst to increase productivity of the office worker. Thus, there will be less office workers needed. Probably a similar movement that we had when manufacturing went abroad, right? Manufacturing was very strong in the Western economies, then it went to cheaper economies. Now we just see an automation of the office workers' work. And yeah, we might get people getting unemployed from this, but then also people will always find ways to make money, right? If they're in struggle, if they need to make money, they can get into services, they can become YouTubers, they can do anything. That's not that boring Excel sheet crunching task or that create, read, update, destroy, this CRUD development that programmers often just repeat. There's many more exciting jobs, right? Many office jobs are super boring. If it can be easily automated with AI, that's going to be done. I don't believe in AI becoming much smarter than a well-reasoning person. There's still room for the entrepreneur. That's what I mean to say. I don't believe intelligence that supersedes human intelligence anytime soon. The S&P 500 will most likely cool off, and that will certainly affect Bitcoin in case it happens. Is this correct? Yes, I do believe that's correct. We see a lot of correlation between traditional finance and crypto. This correlation has actually increased over time. So in other words, the two assets tend to go up and down at the same time. There's very little diversification benefit. So if you hold crypto and if you hold, say, the Nasdaq 100 at the same time, your portfolio will either get crushed or will perform very well. You don't really mitigate risk by owning both at the same time. So in other words, if traditional finance suddenly crashes because valuations are very high, then very likely Bitcoin will get affected, and that of course also affects other cryptocurrencies. So it's true, if we enter a bear market in traditional finance, this will have a bad implication on all assets, but especially on crypto, right? Crypto tends to be a levered bet even on the Nasdaq 100. If the Nasdaq 100 goes down by 20-30%, then Bitcoin can easily go down by 50 or 60%. What's interesting about the recent crash, at the recent drawdown of roughly 50% from the all-time high, is that actually the Nasdaq 100 barely moved. So this is a crypto-specific crash. There's something going on with crypto that is specific, that's idiosyncratic, mainly selling first to the long-term holders. That's not going on for traditional finance. So that's then always the big question, right? Should we buy crypto because it has sold off much more than we would expect based on correlation to traditional finance? Or alternatively, should we wait for traditional finance to crash? Are we now thinking that traditional finance is overvalued and that it might come down? I personally think that the second is probably true, that traditional finance will rather see another dip, which might push us down further in Bitcoin. But I'm not betting on this specifically, again, because I don't try to time different markets that are not crypto. I try to focus on crypto, I try to time crypto properly, and for all other asset classes, I just have diversification. I just add this to the portfolio. Stocks versus crypto do have a lot of correlation. There's not that much diversification benefit, but a little bit is still there. And so I just try to own it all and then rebalance based on my target allocations. This clip was just a tiny moment out of a much longer value-packed video. To watch the entire episode, just press over here. Take your time. Looking very much forward to seeing you on the other side. Just press over here. Cheers!